right, so this will be the module 4 homework assignments. So for this first one, what's going on is investors are more risk tolerant. It says investors are more willing than before to bear risk, right? And what that means is they require a lower return than they required before, right? They're more tolerant of risk. Therefore, the level of return they need to take so much risk goes down. And so the question is, what does that mean for the stock prices? Well, remember that required return is by discount rate. So if my discount rate is dropping, the overall value is increasing, right? Remember, it's divided by R or R minus G. So I'm dividing by a smaller number. So the stock price itself, the V sub 0, right? That goes up. So it's just to help make sure you understand what exactly is driving the relationship, right? Okay, so we're building a portfolio, and we have Ford and Harley Davidson available. Ford has a higher return than Harley Davidson, but you notice it also has a higher beta, right? And we can assume that the standard deviation of the return on the market is 11%. So the beta for the market, would be like 1, right? A beta of 1 is the risk of the market. And we know that their standard deviation is 11%, right? And so this is one that's got multiple questions, right? A, B, C, and then 2 Ds. And so when you see the answers there, we're just calculating what the standard deviation is going to be, right? And so if you look there at the bottom where it says sigma p, that it's sort of like an O, but it's a lowercase sigma. Sigma sub p, which is our portfolio, is equal to, and then you see x sub 1 and then sigma sub 1, those are squared, and then x sub 2 and sigma sub 2, and those are both squared. The x is the percentage, right? So what weight do I have in 1 and what weight do I have in 2, right? Because my portfolio, I'm building a portfolio with buying these 2 things. So if 50% is one, 50% is in the other. If 60% is in one, only 40% can be in the other, right? So that's what those X's are. And then the sigma, that's the standard deviation of the return, right? And when you see sigma squared, you just multiply that sigma by itself, which is the same as the variance, right? But we normally talk in sigma because the units of sigma is the same as the units of the mean. So it's just easier, right? Because we can say, oh, it's 15 plus or minus 5, right? Like we like to be able to have that conversation. So we use standard deviation. And then if you notice in the last part of that, 2, x sub 1, x sub 2, and then you see it looks like a P. I know it looks like it says P1, 2. That's rho, right? Let me grab a little pen here. So that's what that looks like. That is rho, R-H-O, right? That's the lowercase rho. And what this is that measure of correlation between the 2. So -1 is less than or equal to rho, which is less than or equal to 1. If it's equal to -1, then they're perfectly negatively correlated, which is great for portfolios. If the rho is equal to 1, then they're perfectly correlated, and I get no portfolio benefit, right? That means they work perfectly in tandem, and so I can't make I'm making the portfolio with itself, basically, right? But anything in between, this is where all of our portfolio stuff comes from, right? And so with this piece right here, we're saying what, that's what this here is what's the relationship between Ford and Harley Davidson. So like right here, the correlation coefficient, that's what this rho is. is 0.35. So that's where it ends up here. Right, but once we put that in, we solve for what the standard deviation of our portfolio will be. So yeah. And then we have in B, we introduce a third option, right? So 1/3 goes into the Ford, 1/3 goes into Harley Davidson, and then 1/3 goes into T-bills, which there is no T-bill term in here because there is no standard deviation, right? It's risk-free. We will get what it pays, no more, no less. There's no variance around that. Okay. But we'll do the same formula to calculate what it is there. This one in part C, right? The investor is going to invest twice as much money because they're going on margin, right? And so what that ends up doing is doubling their amount of risk because they've just amplified everything, right? They've doubled it up and down. And then again, just shows that if you have 100 stocks, that's what they're trying to say is there's lots and lots of stocks, and what does it look like? And so you start approximating what those standard deviations would look like. Excuse me. And then 7-3, chapter 7, question 3. All of these is just helping you practice using that rate of return. And let me grab that little pen again. So sometimes you will see like, the ending value minus the beginning value divided by this beginning value, or it might be structured a little differently. It's normally kind of how we'll write it. If I do the algebra, this is the same thing as saying the ending value divided by the beginning value minus the beginning value divided by the beginning value, which is the same as this minus 1, right? Which is what this is here. So I just don't want you to get confused. It's the same formula. It's just a little bit of algebra to show a slightly different way of doing it. So let me clear this again. And so calculating the rate of return, we have what it was at the start of the year and what it is at the end of the year, right? And then we also have this dividend yield that we're going to add in, right? And so that's what you see down here is just that calculating the change based on the market value, and then we're going to add in this dividend yield, gets the total return. If the interest rate is 8%, right? So, okay, I have to take off that 8% and they'll tell me what the risk premium is because the rest of this return is because I took on that level of risk, right? And then change it up a little bit. Inflation is 9%. What's the real return? And so if you notice it's 1 plus inflation times, this 1 plus the real is the 1 plus nominal. There's our nominal, right? So then we divide by the 1 plus the inflation, right? And be able to solve for our real. Okay, and then in this one, again, we're going to calculate a real return. The idea, being, we know inflation changes. We see this when they report, they'll say, oh, this month inflation is this, or whatever. And this problem, we're looking at it year over year, and inflation rates are changing over that year. And then we can see what the return on the nominal return on the Brazilian stock market is, and then calculate what that real return would be. So it's just that year on year calculation. But we did this in the last module as well. And then with this, now remember variance, right, is the standard deviation squared, right? So before, when we were solving for standard deviation, we solved for the variance first and then took the square root of that to get our standard deviation. And so that's what all of these are. I know it should be 25 and 5. This is a rounding issue here. So but yeah, and so that's what's going on with these. So calculating the mean, variance, and the standard deviation. Like I said, standard deviation is just the square root of that variance. All right, now this one, sort of like that last one, just feel free to pause to look over it. But what we're looking at is we have each of these investments, right? And then what we're saying is, how are they related? So BHP and BHP are one. Simmons and Simmons are one. Nestle and Nestle is one. LVMH, you know, so they're perfectly correlated with themselves. Remember, I said if there's a row of one, it's perfectly correlated. You're always perfectly correlated with yourself, right? And then this other one, this cross term, is saying, okay, well, how does Siemens change when BHP changes? You know, or how about Nestle relative to BHP, right? And so that's what these terms are. You notice these are all positive, and then once we get to BP, you start seeing some of these are negatively associated, are negatively correlated, and that's okay, right? In fact, negative is can be pretty cool. So given that, you know, these relationships, right? And we know that the standard deviations, correlation coefficients. I'm sorry, let's make sure I tell you the right thing. Calculate the variance of a portfolio. Okay, so we are going to put 1, 2, 3, 4, 5, 6, 7. Right, there's 7 of these, so 1/7 of all of our money goes into these, and then we have all of these like cross correlations with each other. And so that's what we're calculating with each of these is the weight and the variance or the standard deviation, right, for each of these, right, and getting those cross correlations with them, right. And then at the very bottom here, you know, it's a sum of columns, so you just add these up, right, and then sum across to get our total variance, right. I know this one, it's really more just to show, like, once this is just a portfolio of 7 stocks. Now initially we were doing 2, right, or then we would add treasuries as like a third one, right, and the math was already a little complicated. That's why this one's laid up like on a spreadsheet, you know, doing this in Excel. You know, behind the scenes you would have this with thousands, right, of stocks or what have you in the portfolio, and they all have all of these types of references with each other. You know, we can calculate the correlation between all of these pairs, and so it's just really to show just how complex this is. What leads to what we call a variance covariance matrix, which allows us to you know, basically have one big representation of all of these interactions, right? So part of our building of the portfolio when we're evaluating that. Okay, so question 7, they tell us that the standard deviation of the market return is 14%, right? So if the beta is 1, we would expect it to get a return of 14, right? What's the standard deviation if the beta is 1.1? So it would be 1.1 times 14. What's the standard deviation if the beta is 0? Well, it'll be 0, right? but there'll be no standard deviation of returns if the beta is 0, because you would expect that to be like the risk-free rate, right? We don't expect a standard deviation around that. If the standard deviation is 7, what would be the beta? So it'd be 7 divided by 14 to give us that. And then it says a poorly diversified portfolio has a standard deviation of 14. What would the beta be? The beta is going to be less than 1. And it's really just saying this only holds because it's a well-diversified portfolio. If we know it's not well-diversified, we know we're not going to do as well, right? With a beta of 1. So yeah, it's going to be less than 1 because it's we don't have the diversification. Okay, so we have a stock market that has a return of negative 14 or 12, right? And then we're going to compare 5 different stocks, A through E, based on how they do over that same type of change. So if you look down here at the bottom, notice all of the bottom, it says negative 14 minus 12, and it's just this change in the stock market returns, right? And then the numerator is just this difference, 0 minus 16, negative 4 minus 20, negative 24 minus 38, right? Just doing that, taking those differences, taking the quotient between them, and that gives you the beta. So, question 9 says a portfolio contains 6 stocks. We're equally invested in each of them. 3 have a beta of 1.4. The rest of them have a beta of 1.5. Right. So what's the beta of the portfolio? Well, half is in one and half is in the other. So it ends up being halfway in between. Right. And if you notice that line at the bottom, beta measures systemic risk, which cannot be eliminated by diversification, right? Beta is a function of the market. I cannot use the market to eliminate the risk of the market, right? Like that's just, one of those by definition type of things, right? It's systemic, right? I can't use the system to fix something systemic. Okay, I know this is busy, so let me just take a moment. I'm gonna just draw a line. So let me just do this one first. Okay. The expected return piece here, right, is the return on a blank asset expected in the future. If it's expected, that word expected, you'll see things like expected return written this way sometimes, right? The expected return, right? And then you'll see them like say, well, that's the average value or whatever, the expected value. If it's expected, right, that means there's some uncertainty, right? And that's why, so it's risky, right? There's going to be some of that around it. This next one here, right, we're just looking at the risk-free pays this, the expected return is this, right? And so just the 14 minus 6, right? And then there at the bottom, they're just giving you a pair of investments, right? We want higher returns if we have the same level of risk. If we, let me just see real quick, at the same level of return, we want lower risk, right? Those are really straightforward. And this one right here, which one would you prefer? Right, you're just looking at the relationship between the risk and the return, the Sharpe's ratio that we talked about before. This is kind of coming back, right? And so you want a higher return per unit of risk. So you want to get you want your payoff to be a bit steeper, is what that's saying. Okay, so question 4 here, we have the returns, T-bills, right? If you notice the standard deviation is 0 because that is our risk-free, right? And then we have P, Q, and R as our investments. They each have their own returns and their own standard deviation around the returns, right? So if I do 50% in treasury, 50% in P, right, then we can calculate the standard deviation of that portfolio easily enough, right? Half of each. And then what if we do 50% in Q and R, assuming that they're perfectly positively, they're perfectly negatively, and then there is no correlation, meaning rho is equal to 0, right? And if you look over where the equations are written for B, just with no correlation, it looks like a term is missing, or there's that zero there is going to make all of this go to zero, right? And so you're going to see a term basically disappear, and that's okay, right? That's a correlation of zero is really nice for portfolios also. So worst case, you would have been 23%, right? Perfect positive correlation, but anything less than that, you're going to have less of a variance. All right, problem 5 here. They tell us what the cash flows look like. Basically, I'm paying right now to start the project, and then I'm going to get these returns over the next 7 years. My existing assets have a beta of 2.6. I've got a risk-free. The expected return on my market portfolio is 14%. So what's the NPV of this project? Well, the market return is 14%. The risk-free is 4%, right? So I'm looking at, 8% market risk premium. Beta is 2.6, right? And then I'm going to have to add back that 4%. And so basically with our operations, the required return is going to be 30%. So I would look at that cash flow, even though I'm going to get $350 million, the fact that I'm discounting that back at 30% makes it a negative NPV project, right? And it's just our beta is really high, and the expectation in the market are really high returns right now. So even though this looks like it would be a good project, with that expected return, it is not, right? So if you ever wonder why it is raising interest rates, right, which is the risk-free rate, when the Fed does that, how does that slow down the economy? Well, that's what happens. This goes up, the required market returns go up, and projects that look good suddenly don't look good anymore, right? This is another one where it's just like some quick wins, so I just sort of put them on the same slide. Risk-free assets have a beta of 0. Market portfolio has a beta of 1. That's like definition, right? Like that's how we construct that, right? So the security market line is a positively sloped straight line that displays a relationship between expected return and beta, right? And capital asset pricing model shows the expected return of a particular asset depends on all the following, right? The pure time value money, the reward for bearing risk, and then the amount of risk, right? And so let me just draw another little picture real quick. Now that I've learned how to do this, I'm probably abusing it a little bit, but right. And so there's going to be like some risk free, right? So this is beta of 0. Oh, hang on. This is a beta of 0, and this is a beta of 1, right? And then this would be the market return and the risk free. And the difference, right, the return on the market minus the risk free, this is that market risk premium. So that's what we're getting at with the security market line, is this relationship. You're going to invest 20,000 in Bank of America, 14,000 in Twitter. What is the beta? Given that this is the beta of the Bank of America, this is the beta of Twitter, right? And basically, we're just going to say, okay, well, out of all of this, you add them together, what percentage is Bank of America? What percentage is Twitter? That's the weights, right? And then we have the beta. So weight times beta plus weight times beta will tell you the beta of the portfolio. Okay. Problem 10 here. It looks like there's a lot, but let's just sort of walk through what's going on. So pros that the T-bill rate is 5%, right, rather than 2%. Assume that the expected return on the market stays at 9, right? So we've had T-bills that were at 2, now they've gone up to 5, right? Assume the expected return on the market stays at 9. We'll use the following information. We have all of these companies with their betas, right? And a lot of them, you notice they're low beta, right? This is a lot of big firms, a lot of industrials, right? And then they say calculate the rate of return from Johnson and Johnson, right? Johnson and Johnson has a beta of 0.88, right? And so we have a T-bill rate of 5%. We have 9 minus 5 is our market risk premium, which we would multiply by beta, right? And then that would solve for what the expected return is on Johnson and Johnson. What would be the highest expected return offered by one of these stocks? Well, the highest would be the one with the highest beta, which is US Steel, right? So you calculate that one. Which one would have the lowest return? It's the one with the lowest beta, which is Newmont, I guess. And then would US Steel offer a higher or lower if the interest rate were 5 rather than 2? Right. So what if interest rates were higher? Then US Steel would offer a lower rate of return, right? I mean, that's let's see, would Coca-Cola offer a higher or lower rate of return if it were 8%? Right. So if it were to go up to 8%, they would offer more. Okay, so now we're looking at 4 stocks: Ford, Walmart, Citigroup, and Apple, right? And then we're looking at the FAMA French factor. So the difference here, right, is before we were using beta, and beta was just comparing you to the market, right? And now what we're saying is we're going to deconstruct that, right, into different components, right? And so there is market, right? But then there's also the size where small firms versus large firms. And then book to market is those with high book to market versus low book to market, right? And the relationship there are basically like their own betas, almost like beta 1, beta 2, beta 3 type of thing. And so when you see down here, right, with our equation, it's a little longer than what we were just doing, but it's just because we have new betas, multiple betas, right? So they're all going to start with the risk-free rate. All right, this right here is the risk-free. Okay, this right here is based on this first beta, right? I'm going to call it beta 1, which is this one, right? And then the next one here would be our beta 2, which is this one. And then this one here is our beta 3, which obviously is going to be that one. There's a 4-factor, 5-factor model as well, right? Fama and French came up with this deconstruction, I want to say maybe 30 years ago. And a lot of people have looked at it over time because the markets themselves change, and so if you're interested in these things, just Google like Fama French, and you'll see a lot of other things pop up. But then once you have this in place, right, you just here's the interest rate, right, which are risk-free, the expected risk premium on the market. Is 6%, which is where those 6% came from, right? The size factor is 3.2%, right? And then book to market is that 5.1. That's that last piece, right? So that's number 11. Oh, sorry. Here's number 12. And so let's see, we only have two factors, right? This is a two-factor model, right? And we have three different investments, X, Y, and Z, right? And that's how sensitive they are. We're expecting that the risk premium on factor 1 is 5.8, and on factor 2 is 9.8, and T-bills, don't have that, right? So what is the risk premium for the stock? So for X, it's the B1 times that first factor, and then B2, right, which in their case is 0, right, times that factor, right, to calculate what that one is. For Y, right, it's -1 times the 5.8%, and then 2 times the 9.8%, right? You just do that for each of those. For B, suppose you're going to buy 340 of X, 85 Y, and you're going to sell 255 of Z, right? So we're buying that, we're selling that. So positive, positive, negative, right? And then what is the sensitivity of the portfolio to those factors, right, compared to what we were doing before? So first we're going to say, all right, we're going to have, two times our investment will be in X, half of our investment is being in Y, and then we have we shorted 1.5 times of Z, right? And so it's like we took out a loan, basically. It looks like, if we add all of these up, they still add up to 1, right? It's just that we sold one when we bought the others, right? But now that we have those weights, we just have the weights times each of those, right? So 2 times 1.75, 0.5 times -1, and -1.5 times 2, right? And so the sensitivity for each of those is 0 and -0.5, right? And then the expected risk premium, right? It's less sensitive right there on factor 2, right? Excuse me. And so, yeah, the half of the 9.8%, right? Or negative half, right? Minus 0.5, right? And so it gives us our minus 4.9%. Right. And then C, you're buying 136 of X, 102 of Y, and you're going to sell 68 of Z again. It's negative. They're all going to add up to 1 again, though. It's just one of them is going to be negative in this case. But we'll do the same type of calculation just based on those new ones to get our expected risk premium. And then the same thing for the D. You're going to buy buy X and Y, and again sell Z. And then again, what's your sensitivity, and then what's your expected risk premium. So please let me know if you do have any questions or concerns, and I just look forward to answering your questions later.